Are interest rates going up or down? And whether they're going up or down, does it really matter? Because banks are changing lending policy. We need to know about that. And are there any opportunities in this current real estate environment for investors? I'm joined today by Kyle Green of the Green Mortgage Team, an expert extraordinaire. We've had him on the REIN stage many times. Kyle, thanks for joining me.
Happy to be here.
So Kyle, let's just open up this conversation, get on point right away. What are interest rates going to do? Are they going up or are they going down? What's your view of the world? You're kind of an inside guy. What's going on?
Well, what I'm hearing is both, which doesn't make any sense.
They're going up and they're going down?
Yeah, exactly, literally. So here's what the people that are professionally betting on what's going to happen are saying. They're saying that the Bank of Canada is likely to go down another about 0.5% over the next few months here. But then after that, there's a bit of a divide. Some economists and banks think that's it, just 0.5% and no more cuts. Some banks think the government's going to continue to cut even more aggressively and go 0.75% even further than that. So meaning that we could be 1.25% lower than we are today by the end of the year, which is fairly aggressive. But some economists and banks are expecting that might happen. At the same time, those same economists are also predicting that the bond yields, which impacts fixed rates, is going to slowly tick up year after year after year for the next 5 years because of the inflationary effects of the tariffs. So we're in a weird spot where it's possible the Bank of Canada might be cutting at the same time that the bond rates, i.e. fixed rates, actually go up, which would be very interesting and very confusing.
It will be interesting and confusing, yes. Sorry, go ahead.
Yeah. No, I think it'll be a weird time. So, I mean, as an example, we've had the Bank of Canada cut for the last 6 months. And every time the Bank of Canada cuts, we have clients saying, hey, so the Bank of Canada went down 0.25%. Do I get 0.25% better of a rate on the fixed rate side? And the answer has been no, because the fixed rates had already been low. The Bank of Canada's been cutting and the fixed rates haven't really moved a whole lot since probably October, November last year. A little bit of movement here and there, but not significant. And I'm really not looking forward to fixed rates actually going up. So customer says, oh, variable rates went down 0.25%, so I get a lower rate, right? No, actually they're higher now, right? That'll be an interesting conversation to have.
It is going to be an interesting and, to your point, a confusing time. The uncertainty is there. I think that, from my point of view, when I'm looking at what's going on economically, we talk about GDP and we talk about unemployment, we talk about all of these economic fundamentals, but there's something that many are stepping over. There's three things that I think people are stepping over, and 2025 is going to be very uncomfortable. I think it's going to sting. I was going to originally say it's going to sting a little. I actually think it's going to sting a lot. Now, here's why, Kyle. We look at consumer confidence, record low. We look at business confidence, record low. I mean, just those two things alone are enough to kind of slow the economy down in a really epic kind of way, because consumers aren't spending money, businesses aren't growing, they're actually hitting the brake, they're not buying more inventory, they're not hiring. As a matter of fact, many are even cutting back. Add to that the confusion around the politics and tariffs, what Trump's going to do or not do. Do we really have a prime minister? Is Carney really our prime minister? He's not really voted in, but arguably he is our prime minister. So much uncertainty and so much confusion, then our immigration numbers are down. All to say this, I think that the Bank of Canada is between a rock and a hard place, because if they don't lower rates, it's going to really, I guess it's going to take us down this whole path of economic slowdown in a much bigger way. But their fear, of course, is that if they lower rates, then we're into this whole inflationary world again. But I don't think we're going to be into an inflationary world, because people are not spending money. Canada is driven by consumerism and real estate, and both have all but stopped. So that's my long-winded way of saying, I think to your point, I think variable rates are going to have to come down. I believe that. I don't know how much this year, but I think they're going to be no choice. And bond yields are going to go up and fixed rates are going to go up. That's how I'm seeing it. And what the hell do I know? That's my view of it. What do you think?
Yeah, I think I agree with that, based on, again, just what the economists are predicting. And I usually try not to make my own predictions as much as follow the people that are literally putting their money where their mouth is and like professionally bet on it. And it's interesting. It makes sense that this could happen and would happen. It's important for people to understand that as much as the Canadian economy might be weak, the U.S. or the Canadian bond market is very tied to the U.S. bond market. So, since last October, November, when Trump was elected, that actually caused a massive spike in the U.S. bond yields, which has created a bit of a floor underneath Canada. So usually weakness in an economy pushes interest rates down, and that's not really what we're seeing. It's weird though that Canada is showing a lot of weakness and the U.S. is not, and it's kind of creating a bit of a floor underneath the rates. So I think ultimately the question that comes up then is, should it go variable or fixed? And more than before, like, probably since September of 2023, I've been, for the clients that can stomach it, I've been promoting a variable probably will end up saving you more in interest if you go variable versus fixed. And I still think that the models are still showing that is true, although the gap is tightening a little bit. And I think the key really comes down to, okay, if the gap is tightening and the pendulum doesn't show that there's a massive potential savings of going variable, then I'm finding my investor clients are more likely to go variable. They're willing to place the bet, and they're less likely to be in a position where if the rates go up, that they won't be able to afford it. And then I'm finding that my first-time buyers and homeowners that are on more of a fixed type of income, salary employees, etc., they're just not taking the risk. Let's just go with a fixed rate. A 5-year fixed rate is now becoming one of the most popular terms again. And a lot of people are thinking, I just don't want to have to think about it, don't have to deal with it. So
is on a fixed rate basis, are we getting into high 3s, low 4s? What kind of fixed rates are you getting on, let's say, a 3 and a 5?
Yeah. So generally speaking, an insured mortgage now, you're getting into the high 3s, like 3.99% is available with a number of different lenders at the moment. Even some lenders offering 3.89%. So insured mortgages are very competitive. Uninsured mortgages would be in the low 4s. And I'm finding that generally speaking, the 3-year and the 5-year fixed rate terms are very similar to each other. So the rate is usually within 0.05 or 0.1% of each other. Some lenders, the 5 years lower than the 3. Some lenders, the 3 is lower than the 5. Kind of depends on the institution.
And what about variable? So somebody going with let's just say a fixed variable, fixed term variable. What's your kind of low number there?
Yep. So insured, there's a lender that's actually doing as low as prime minus 1.05, which is very, very deep. But generally speaking, over the last few months, there has been a compression on the spreads on variable. And so you can't get as deep of a discount as you could last year. So prime minus, 1% or at least 0.7 or 0.8 was widely available. And now a lot of those lenders are starting to shrink the spread. So in insured mortgage now, most lenders are prime minus 0.65 to 0.75, and then there's a few outliers. And then if it's a conventional mortgage, then most lenders are around prime minus 0.5%, sometimes as good as prime minus 0.7 if you fit certain criteria and parameters.
So where does that put us as a number? 3, low 3, mid 3s?
No, you're still, if it's insured, then you're high 3s. And if you're conventional, then you're in the low to mid 4s.
Low to mid 4s. Now, do you see a scenario, before we switch topics, but do you see a scenario where you see a fix that's, as much as 1% plus higher than a variable?
A fix that's higher than a variable, only if you're going with a short term. So 1-year fixed or maybe a 2-year fixed, the pricing is much higher on the 1 and 2 years. And then the question is, well, if a 1 or 2-year fixed is by nature a short-term rate, just like a variable rate is, you're only buying the rate for a very short period of time because the Bank of Canada can move up and down. I don't really know why you go with a 1-year or 2-year unless you were very certain that I'm going with the 1 or 2 year because I'm going to sell the property in a short period of time. I'm going to sell it after 1 year, sell it after 2 years. But in reality, that's very rare that somebody can time the sale of a property with that kind of certainty. So it's more difficult.
So interest rates aside, let's move on to the next topic, which I think is as big a topic, which is lending policies are shifting again. So it's not so much you walk up, get a mortgage. There is more involved. My lenders are reaching out to me, like for sure, at least 6 months in advance going, hey, what are you doing with this mortgage? Let's talk about it. Let's book an appointment, which seems a little more I don't know, aggressive than historic. Usually, in the past, it's kind of the letter shows up. What do you want to do? But this is literally reaching out saying, let's get on a call. Let's talk about it. Let's put a plan together. Not negative in any way, not threatening in any other way, other than they're just being very, I don't know, communicative way in advance with what I've normally seen. But what's your experience with it?
Yeah, so on the renewals specifically, it's interesting. And I have a feeling that there's two reasons for that you're hearing so early. Some lenders do have a policy where they typically would reach out and do an early renewal 6 or even 9 months in advance of the renewal date. I've been finding that they've been more on it lately on the renewal side. Lenders are more likely to give you a more competitive interest rate on a renewal because there's no real cost involved with doing that renewal. There's somebody getting paid $25 an hour that slides a piece of paper across the desk and talks to you for half an hour. It's $12.50 to do a renewal, right? If you want to rebook the mortgage, now you have to go through, an underwriting team. Somebody's got to deal with you. You're either going through a mobile specialist that gets paid a commission or a broker that gets paid a commission. There's all these costs involved with funding a new mortgage, and so on renewals they're a bit more aggressive. But so I think there's part of this is just lenders are trying to look at the fact that, hey, an existing customer is the cheapest customer, right? It's more expensive to get a new customer in the door. Let's just retain the existing customer we have. That's number one. Number two, I think is if you're looking at where interest rates were 3-5 years ago, and you have that mortgage booked initially, you're at a lower interest rate than what you're renewing at. There's an interest in the bank early renewing you. If you're at 1.69% and you renew 6 months early and you jump into a 4% interest rate, then you're foregoing that low interest rate that you have. And I think most clients are wise enough to understand that they're jumping up and getting ahead of it. But I have seen some clients early renew. I'm like, why? Why would you do that? Unless you feel like your interest rates might be rising, but that might be the positioning, right? Hey, customer, you should early renew this because the tariffs rates might go up. You should get out of your 1.69 and jump into a rate of 4% today.
Yeah. There's, I want to just say that, to anybody that's looking at renewing or getting a new mortgage, I'm just going to encourage you. There's very few soapboxes I stand on, maybe politically, but, in this space. And that is to say that I'm going to encourage you to deal with an independent mortgage broker, somebody like Kyle. I cannot stress that enough. As much as you have relationship with your bank, whether it be a TD or a CIBC or Scotia, it doesn't really matter, any of the big fives. It would be a disservice to yourself by not dealing with a independent mortgage broker. They do so much more than the banks. So I'm going to encourage you to do that. I just needed to say that out loud because I believe in it so strongly that banks do what banks do, but the unsophisticated borrower needs to sit down with a mortgage broker that has way more options. So I just wanted to say that out loud, Kyle. So Kyle, let's talk about investors. I mean, the Real Estate Investment Network, Green Mortgage Team, you are certainly end user. That's part of your focus, but investors over the years have been part of your focus in lots of spaces. So when you look at what's going on in the market, are you seeing more opportunities for investors, less opportunity? What's your thoughts on where the investor real estate market is? It's gone cold. I would call it almost ice cold. Maybe not dry ice cold, but it's freaking cold. So what's your read on it?
It's cold. It's thawing a little bit. Now we're heading into spring. I think the reality is it went so cold, especially in 2023, like nothing happened. People were investing in GICs that year, right? Like, oh, I can get 5% and have no risk. That seems good. And then 2024 saw a bit of a comeback with some investors wanting to get a little bit more active. And leading into this year, a little bit more activity. It pales in comparison to where we were pre or during COVID. The investments just doesn't make a lot of sense when prices are elevated due to high inflation and interest rates are elevated too. It's really hard to make the numbers work. It's hard to find anything that cash flows in many major urban centers. Yeah. And I think that's the primary issue and concern. And then there's also all these questions about how are the tariffs going to affect certain areas. Like, as an example, Alberta is a great place for cash flow. It's much better than, let's say, BC or Ontario. But then also, if you look at the tariffs and which industries get impacted the most by the tariffs, you look at the list and like, That's a lot of Alberta, right? So it's a really tough call. Like, where do you invest right now? The flip side of it, however, is that generally speaking, when the supply increases in markets, there's going to be a larger percentage of people that are more motivated to sell and may need to sell. So what I'm finding, and I have a few clients that are doing this right now, is they bought before they sold, and the clock's ticking, and oh my gosh, I need to sell. I had a friend of mine who was selling a place, and they had to drop from, I think they wanted to sell for $950. They ended up listing for $929, and eventually having to do $899, nothing. Oh my gosh, $849, and eventually they finally got some bites at the last minute to sell it. So they thought that they had undervalued it, but if there's no buyers around, then those motivated sellers have to sell it and they have to move it. So not to say that the opportunities are going to be good enough. Like, is that property at $849 still a good deal for an investor? I don't know, but I think that the reality is there's going to be some people, there is some blood in the streets, and that for an investor is usually good. You just have to keep your eyes open. And now with interest rates kind of reaching a point where fixed rates are probably about the bottom for the next few years or very close to it, some downward pressure with variable rates, and then also maybe some opportunity in the real estate side of things, you might find some opportunities, but I'm not telling you to run out there and buy the next thing you see. I think you need to be patient.
Well, I think and the other thing is that you have the time to be patient. You can actually afford to be patient because there's time in the market. That's just the way the market is right now. But I want to go back to something you said around the tariffs and then back to lender policy, jump around a little bit. You know, I've heard from some insiders who the banks have actually issued statements within internal statements saying, you know, if you've got a borrower in specific industries, I'll use automotive, for example, where tariffs are going to impact that industry and they're anticipating layoffs, there's more caution being exercised around certain industries because of the possibilities of significant job cutbacks in those industries. And the banks are going, look, we're putting a red flag or a yellow flag on these industries. Anything that you know about that, or have you heard, or what's the insider on that?
Yeah, so generally speaking, a lot of that policy is more gray area, but there is some black and white policy being rolled out on that. So BMO actually was one of the ones that came out with a list of people that they consider to be high risk industries, and they said if you're self-employed and you're in one of these industries, then we're tightening the debt servicing ratio and we're reducing it from here to here. So there definitely is some black and white tightening. Not to mention, we've seen other banks. Scotiabank has tightened up on a lot of policies. As a mortgage broker, we've always really liked Scotiabank for a number of different reasons. But they were the last lender, the last federally regulated lender anyways, to use what's called a rental offset instead of an add to income on the rental property that you're financing. And eventually, just because of a lot of government pressure, they finally relented, and now they no longer have that as of a few weeks ago. They've tightened up policies, and it seems like every 3 or 4 weeks there's another policy tightening. And I do find that often when one bank goes through a wave like that, it's often due to either funding sources, and they just have to start to like control the flow of deals coming in and improve quality and lower quantity. But it also sometimes is due to like a bad audit. CIBC went through that back in, I think, 2018. They had a bad audit with the government. Clamped down really tight. Maybe Scotia went through the same thing. So it's interesting to see that. That's one benefit, of course, of using a broker is, okay, one lender tightened up. Maybe that's the bank that you have a relationship with. Well, maybe another lender has not tightened, or maybe has even loosened at the same time. So, we're always kind of finding, it's interesting seeing a client with 10 rental properties. We're like, yeah. 6 years ago, that lender had the best policy, so we put a bunch of deals there. And then, 4 years ago, we did the last 2 deals there. And now this lender's more open, so now we're sending it here. And you kind of scatter it around a little bit just because of the changes in lender policies and lender appetite.
Well, listen, at the end of the day, you and I have been in this industry a long time, and we've seen the pendulum. It swings always extreme one way and then extreme the other way. It never really seems to find center for an extended period of time. Kyle, I wanted to say thanks for joining me today. Now, where is the best place for people to get a hold of you? Green Mortgage Team, or have you got some specific places you'd want people to go to follow up with you?
Yeah, you can go to our website, www.greenmortgageteam.ca. Email info@greenmortgageteam.ca, or you can call us 604-229-5515.
Fantastic. And we'll put those in the show notes as well. Kyle, as always, appreciate your insights and your professional perspective of what's going on in this particular current lending environment. So thanks for your time. Appreciate it. Folks, I can't stress enough, reach out to an independent mortgage broker. Green Team is the place to start. Thanks, Kyle, for your time.
Thanks, Patrick.